For some time now, I've been thinking about recording a video to talk about our system of money and banking. Um, there's a great deal of diverse opinion about how the system ought to be changed, how it should be reformed, and my views are generally not accepted by very many of the people who are looking to change the system. The predominant view is that what we need is a system of interest-free money or debt-free money created directly by government and putting in controls, some sort of regulations over how much money can be directly created and spent into the economy by government. And certainly I would agree, and I do agree, that that is a better step than the system we have now, which allows the central bank, at least in the United States and many other countries, to expand the money supply out of thin air by simply creating digital monetary values and then using those created values to acquire government securities, which then transfers the money to the government so that it can be spent into the economy. And there are serious consequences of this system because the money is lent to government at interest. Then the government, in order to raise the revenue to pay the interest, has to raise taxes or some other way obtain fees for services performed in order to get to that point where they can pay for government expenses and to pay the interest on the debt. And in the United States, we've gotten to a point where there is absolutely no thought of or potential to actually pay down the national debt, the public debt, which is fast approaching $30 trillion. So the Federal Reserve, as it looks to its tools in response to the potential for inflation, even though the Federal Reserve doesn't really calculate inflation to really account for the real cost of living that has occurred as a result of reduced interest rates during the last 7 or 8 years since the Depression of 2008. Well, the only response they have to rising inflation is to raise interest rates and tighten the credit markets. And when they raise interest rates, that means that as every government security matures and is refunded by the issuance of new securities, the interest charges on those new securities is going to be higher and higher. So the Fed is kind of between a rock and a hard place because it just doesn't have the power, in my view, to stabilize the economy through monetary policy. So we need really to look at fiscal policy as a way to turn things around, and the change in how we raise revenue, moving to a rent-based system of revenue that frees earned income and capital goods and commerce from the tax base, is really the only way that this will be accomplished. And that was detailed over a century ago by Henry George, and many economists throughout the 20th century and even today are still making the same arguments, but making little headway with the political machinery that's needed to support these measures. So getting to the situation with regard to the monetary system and what should be done, as I say, the movement to the government issuance of currency is a step in the right direction. If we look at the history of the central bank in the United States, we can go back to what the scheme was that was developed back in the late 1800s as a result of the many panics, and particularly the Panic of 1905 stimulated the commissions that were formed to discuss whether or not to have a government issued currency and whether to have a government owned and run central bank. And the bankers were certainly influential in ensuring that that did not occur. And we ended up with a Federal Reserve System which is basically owned by the commercial banks and which pays dividends to those banks based on profits. and which has some government oversight, but essentially has been charged with operating independent of the political system, with the object of keeping the money supply adequate, and also controlling inflation. But of course, critics have rightly observed that the purchasing power of the U.S. dollar has declined almost continuously since the establishment of the Federal Reserve System. The historian Carroll Quigley wrote one of the most penetrating analyses of the politics that went behind the formation of the Federal Reserve System, the involvement of J.P. Morgan, and the influence of Edward House on the decisions that were made in the Wilson administration. So that's the system we have, and we have suffered consistently with boom and bust cycles, not caused by but exacerbated by the Federal Reserve and banking system that we've had in place. So what do we do about it? How can we get the genie back in the bottle if in fact that's the answer? My position is that economists really need to take a look, and policymakers as well, anyone who's objective, take a look back in time to when the system was relatively stable and what were the factors that contributed to that stability. And one has to go back all the way to the early 1600s, and in particular the creation of the Bank of Amsterdam in 1609. The Bank of Amsterdam was a publicly owned bank created by the city of Amsterdam, which held its shares in stock. It was not a lending institution by design. It was a bank of deposit. And what it did was to serve the global economy by taking in all of the various coinage that circulated throughout the global economy at the time, as well as bullion that was brought in, melting it down and putting it into coins that had a standard weight and content of precious metals. And those coins were the money supply. People obviously would rather not carry around precious metal coins on a regular basis. There's a lot of risk of them being lost, that your money is gone, etc. So the Bank of Deposit generally held that coinage in its vault on behalf of depositors, then issued what amounted to certificates of deposit or receipt money that was then used to make purchases and circulate in the commercial world, as well as in some instances was acceptable in payment of taxes. So the system really was a full reserve system. The bank did not make loans. Its depositors could in fact use their balances at the Bank of Amsterdam to become a lending institution. This is money that they owned, that was theirs, and they now had a receipt money version of that they could loan to others at interest. And so, this enabled the global economy, as one economic historian, Emanuel Wallerstein, has written, to really grow with a minimum of inflationary pressure because of the role of the bank in making sure that the purchasing power of the circulating currency was stable, that it had a consistent backing. Now, there's a lot of criticism, justifiable, about the use of precious metals as backing currency. We have to mine the ore, refine it. It is damaging to the environment. And then what do? We take the coins, and once they're all the labor and capital goods that are used to mint the coins, we put them in a vault. And we have to make sure the vault is protected so that there's no theft of the money, etc. So it's not a perfect system, but the idea of a stable purchasing power for currency is really one of the issues that I think deserves further consideration.